All right, well, that was not the move that a lot of people were expecting, based off of how the market performed the last 4 days, and obviously how it performed today. It was not the inflation report we were looking for, and it was not the market reaction that we wanted or needed to see if we're going to get the Tom Lee rally, right, which is the rally into the end of the year, up to new highs. So. Now that looks less likely because, again, we talked about why it was so important that we be where we are, and then today I'll break down all the indicators and how they're looking now, and then where this selling will ultimately take us. Like, again, well, whether it will take us there tomorrow or whether it might not be till the end of October or the October expiration. Most likely be that scenario where it will just be kind of a grinding up and down pullback. So we're going to take a look at today's selling in context of other big sellings we've seen so far this year. What makes this one different, if at all. We'll talk about how the different asset classes are performing that's driving a lot of that. So we'll see some interesting patterns there, as well as the sector performances. What we saw there was what we needed to see on the flip side in the last few days that we didn't. So I'm going to show you what and why that matters. And then today's trade ideas in the stock that broke down today, so most everything else, but had not been as bearish and seems to have more downside potential to it than some others. So we'll talk about that and how to trade that. So let's go ahead and get started. Today is Tuesday, September the 13th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. Before we get started, I invite you to subscribe to our YouTube channel with that icon right here. Hit that thumbs up icon to like our video. Comment down there on anything that stood out to you from today's video. Join us at marketscholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these things on the right. Come down here, click on that heart. It opens up this tab. Hit that like button. Also click on this thumbs up icon. It opens up another tab. Hit that like button. Again, the more you do that, it helps us get our content out to all of our followers on those social media platforms. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. And obviously a big turn down today. It brought the near-term line back out of bullish territory. The momentum line did not close at extreme lows. Close, it was at 5.76. Of course, getting below 5 is the extreme for the momentum line. So needless to say, that's a pretty significant drop. 4% back below the 30-day moving average. So obviously we had a nice good rally, and pretty much most of that rally is gone in one day. So it kind of goes to show that the market was trying to front run something that never existed, and that's why you don't front run something that never doesn't exist. You want to see what you got before you do, and that's what ended up happening here today. The intermediate line is actually still rising, and market sentiment is still rising. Market sentiment, though, is not quite above 60 yet, and the intermediate line is still in bearish territory. So as soon as, we're still below the moving average, so it's falling, and it's going to continue to fall because we're that far below it. So it's still red, and will turn as soon as the intermediate line turns down, which, barring a tremendous jump tomorrow, it will, and you'll be back to dark pink shading just like that. So, and more than likely, the near-term line will fall back into bearish territory tomorrow too, depending upon what kind of follow-through, if any, that we get tomorrow. Let's look at some of the other indexes. The NASDAQ 100 got hit pretty hard today, and you can see, again, very similar pattern. It did drop below the 5th percentile. Its market sentiment line is actually pretty close to 60. Remember, the Russell actually did jump up above 60, right? So it still is above 60 and slightly rising, an intermediate line falling. But everything pretty much looks the same. Go back to the SPX. From a Fibonacci standpoint, remember, we had gotten above the 38% retracement of the intermediate decline and the 38% retracement of the year-to-date market sentiment decline that we had been retracing over the last few days. We got above both of those, and we got back below both of them in just one day. So just like that, we're back. I mean, those are resistance levels when you're on trying to rise to the upside, and we're right back below resistance just like that. Of course, the important level here really is this 3850-ish plus or minus a few points, where all these lines are in conjunction, because you got these 23% lines Again, we got down here just a week ago, and it held for a support with that cluster. Obviously, we're not going to get a cluster right now, but it held for support there. If we get back below, remember, getting back below those lines signals that this retracement that we've been on pretty much since July is done. Right? The retracement starts when you get above those 23% lines, like we did right there on 719. It ends when you get back below those retracement lines, or above the other direction, right? If you above the 78% lines, which we haven't gotten close to. So getting back below those lines would signify that this retracement to the upside is done, and that we're going to start a new leg lower off of an intermediate high point that was well below the last intermediate high point there. So there's that. But there's also these two lines, the black and red lines. Remember, those are support levels based off a long-term bullish trend. So they're very significant and important support levels because of the length of time that these Fibonacci lines are drawn on. The red line goes all the way back to the 2009 low point, so pretty much this current secular bull market that we've been in. And then, so that getting below that signals that we are now retracing that multi-year, like, 13 years bull market that we've been on since that March 09 low point. So we're finally, we kind of faked out a retracement beginning there, and we came right back up, and faked out a few more times, came right back up. So again, when you this, like we talked about over here with 4,200, when you fake out below a level and then you retest that same level, it tends to hold the next time. So getting back below 3850, 3820 would be really important from that perspective. And then the black line is the COVID low point, right? So again, we've already been retracing that 23% lines right up here for the COVID low. We've already been retracing that bullish move that ultimately peaked right at the beginning of the year. That retracement started back here in April and May when we finally got through right there. So we had flirted with it. We kind of had a little bit of a fake out there in March, and then we finally got down and stayed down there in April and May. So we started that retracement, flirted with ending it with that fake out there in August, and then now we're back down, and then obviously getting bringing below that 38% is a support level, Fibonacci support. So we would be breaking down into that support and expecting to move lower. So really important lines here across the board that we kind of, again, 3850 plus or minus 30 points or so. To the downside to 3820 and to the upside around 3920. So right in that area is where we kind of need to, to kind of hold and not get down significantly below. But again, more than likely, if we retest those lines like we did here in June, then, and that was kind of a fake out there in June to the break, with the faking and the breakdown to the downside, you're more than likely going to hold it the next time. So we'll definitely keep our eye, especially with the intermediate line still below market sentiment. Like that's bearish. Getting back above market sentiment line is what we really need to see. And we had, we were looking good, even though, like we said last night in the video, there's still a lot of things that we were missing. We should not have been missing as many bullish signs with that bullish of a run, right? We've seen bullish runs like that in the past, but the ones that were missing a lot of these bullish signs were the ones that failed. We had a couple, and this will drop right there. We had two, really good 4-day rallies during that decline, as I showed you, and they failed. So that's what we have again right now, failing again. Let's take a look at this, the Hakiyashi candle here on the weekly chart. We got a red arrow again, just like that, and we got a higher close, and we were looking pretty good yesterday of getting I think I showed you the close above that body. That would have been a really good reversal. Of course, it was only one day because it's Monday, and this is technically still Tuesday. There's only 2 days, but we're still getting a transition candle here. So we either need to close below this low point, which is the lowest close, and that would signal a continuation of the bearishness, or we need to close, so that would be below that low point right there. So we need to get a Hakiyashi close either this week or most likely next, below 39.81, or we need to get a Hakiyashi close above this body to signal the reversal off these transitions. So we need to close above 40.76. And again, a Hakiyashi close is more significant than a regular close because it's an average of all 4 values in the regular candle. And obviously, when you look at that transition candle there and you see it on this basis, that's pretty bearish. You got the red line. I mean, we're easily below that 10-week moving average again. The PPO is falling again. So, again, more than likely, if I had to bet, are we going to close below this low, this close, or are we going to close above that one, close above that one? I would bet that we're going to close below that one. It's kind of like, would you rather bet on BYU beating Oregon this weekend or Oregon beating BYU? I think, we would want to be we would lean towards the BYU side of things because they're the good guys, and well, in this case, it's the more likely scenario. It just happens to be the more likely scenario. Let's take a look at the 3 green arrow chart. We were so close to getting 3 green arrows, right? And we were like, we were just right there. We would have had it yesterday. Now we're still got 2 green arrows, but nowhere near getting the 3rd. The Dow actually did get 3 red arrows again, so we're back to pink shading, just like that. The Qs don't have it yet, right? So we don't have it yet, and the Russell doesn't have it either. So it's really the Dow, it's the worst. It's the one that's actually closer to its lows than all of them. But the others are more than likely going to get 3 red arrows tomorrow. So you need to get 3 green arrows and hold it to get a good trend going. Getting 3 red arrows again just perpetuates the bearish trend the bearish leg lower that we're currently on right now. Especially when you look at the close, getting back below multiple moving averages. In this case, the 8 and the 17 at the same time, and as well as the 50, because the 50 happens to be down there. So very significant from that perspective, and we are, pretty well below the 17-day moving average. I mentioned to you before, I mentioned in my class today that this is the worst loss of the year for SPY. It's not the biggest gap of the year, but it's the 4th gap of over 2%, and it's the 1, 2, 3, 4, 5, 6, 7, 8th close below 3%. So that's a combination. But there's only been, out of all these times, there's only been twice that you've had both of them, where you had a 2% or more gap to the downside, and you ended up closing more than 3% lower. And both of them occurred here on June 13th and June 16th. So to kind of give you an idea of what it looked like, and here let me pull up, because either these washouts, they either start both moves to the upside or downside. They either start the moves or they end them. And 13 and 16, you can see when we got that one there on 13, we were 6.85% below the 17-day exponential moving average. That was extremely low, and I think I shared with you back then that that's one of the lowest periods that we've ever been that low on the MACD for SPY. It's really, really low. That's why I thought this was the washout phase. And if we retest these lows, it'll be a lot slower, more of a grind to the downside than what we saw there. So, and then on 6/16, again, you were 6.88% below on 6/16, the 17-day moving average. So we were already significantly lower. The MACD was below its moving average. You were significantly down there. The histogram was also really low. You can see the bars. That measures the gap between the MACD and its moving average. I mean, we were washing out. Those were big moves that will wash things out. This one, not so much, because we are only 2.5% below the 17-day moving average, and we are just barely, the MACD histogram just barely turned red. So we are nowhere near washout levels. Now, again, I don't think we're going to fall, back to back days of 4.3%. If we continue to move lower, it's going to be smaller moves to the downside. Again, you look at this chart, and when you tend to get really small moves after the big ones. Really, you can see this one here, this one here. This one was a small upward move. Here was a small downward move. And over here was a much smaller, only 0.5% down. So when you get these big declines, you end up either with a small loss or a small gain. So that's the most likely scenario, unless you can see we built into that one, and then these kind of just came out of nowhere after big gains, and that's what we had here. So I don't expect that we'll get another 2 or 3% drop tomorrow. I expect that at most it'll most likely be like a 1%, if that, right? It'll more than likely be around 0.5%, or maybe even a small gain tomorrow, based off of past precedent. So keep that in mind. Don't expect that we will wash down to these lows Like, you know, like it's not that binary. I know the TV seems to be that way, right? Because every day we get a down day, it's like, are we going to retest these lows? And every day we get up there, we're going to get back to 4,800. We bring Tom Lee on the up days, and we bring all the bears on the down days, you know, saying, well, we're going to retest these lows. And then Tom Lee says, well, we're going to get back to these highs on the up days. And we're not that binary. It's not going to go down, you know, in one fell swoop. It's not going to go up in one fell swoop. It goes up and down, and as you can see again on this chart, not, you know, these kind of moves are just rare. As you can see, it's the biggest one of the year, and it's the 8th one out of how many candles and how many periods we've had since the beginning of the year. So it's not like these happen frequently. Let's take a look at the intraday range here. You can see we did lower high, lower low. Obviously, we close at the low of the day. It's a runaway gap, right? We talked about these yesterday being common gaps, and that's why remember we talked about, like, we were less like we were hoping that we'd be in this area after today when we got a good Arun indicator for tomorrow. So remember, the Arun indicator tomorrow is going to show, you know, the green already has hit 0 today, and then the red's going to get below 70 tomorrow. So we were hoping that once you got that pattern, that we would be in the upper half of the chart. But lo and behold, we didn't. And now we're a lot more likely to get the red line to spike back to 100. And remember, it takes, when the red line spikes to 100, it takes, you know, 6 days for it to get back below 70. When it gets to 100, it takes 6 days to drop down below 70. So that kind of, if we get a new 4-week low, it resets a clock. And every day after that, until you stop getting those new lows, until you get the last new low, you reset the clock every time for 6 days, which is a full week before you get the red line back below 70. And fortunately, the green line's already at 0, so, you know, it will already be where it needs to be. You just got to get the red line back below. And it looks, again, the red line is the low point, the green line is the high point. It doesn't look like we're going to get a new high anytime soon, and it looks much more likely we'll get a new low, even potentially as tomorrow. So the red line, it might not ever drop below 70. If we get a new low tomorrow, then it'll spike right back to 100 and reset the clock again. We have to wait 6 days until it gets back below 70 again. The hull flipped around too, but not the actual whole moving average, just the bearish candle. So again, we got a lower close than what we had there, and we already are below that low, you know, close below that. So that's a reversal. If there's a reversal candle in Hakunashi, that's it. And not only did we get a lower close, but we closed below that body. So just like that, and we were almost flipped. That parabolic star is going to flip most likely tomorrow. If we get any new low tomorrow from today, then we'll flip that parabolic star to the upside. And then it's going to be a matter of how far we get below the 20-day hull, and when that rolls over, because you can see, like, we're already, you know, almost right back down to the 200-day hull, and that gap, which is what the green line measures, is already below its moving average. So just like that, we're like right back to being pretty bearish. I mean, look at that's the size of the bearish candle. It's a pretty decent size bearish candle there. Sorry, I got something flying here in my face. Let's take a look at the VIX. The VIX jumped up, but did not close at the highs. In fact, if you look at the VIX here, like, we were at 27. We did not get above 100%. Like, as bearish as we are, as big of a range as we got, like, we had a really big range. We had, you know, because you have to include the gap. So when you look at 410.97 to 403.10, you're looking at, you know, what? The low, close, 410.97 to 403.10. You're looking at about 7 points, almost 8 points of gap added on to the 11 points during the actual trading range of the day. So you're looking at about a 19-point range, including the overnight trading session. That's over 3 times the average. That's off the charts. The volume was 120 million. If you look at over here, 120 million is not quite off the charts. And then, of course, the 19 points is well. I mean, but those lines are rising, and we're right back to almost 2%. So getting back above 2% would, you know, again, signal that we're on a new leg lower to the downside. That's how big the average is already almost, you know, 2% of the price for the index. So we're already pretty darn volatile. Yet despite that, the VIX can't close above 100% above, relative to the VIX 3M. So as bearish as we are now, the VIX as bullish as it is, VIX 3M also remains stubbornly high. It continues to really, really push up. Again, getting above 25 is just really, really high for the VIX 3M. And it's been persistently above 25 for most of this year, and remains that high. That's why the VIX can't spike above 100%. Above, usually during these corrections like we're on, you usually get to 115, 125%. We can't get there because the VIX 3M is so high. And why is the VIX 3M so high? Because the market's not worried about a typical correction. The market's worried about, what a bear market, an actual bear market, which again goes beyond the limits of a correction. Remember, we haven't even hit the 200-week moving average yet, and that's pretty much what defines a correction. Getting down like here in the fourth quarter of 18, a little bit deeper in COVID, but that's what defines a correction. And we haven't even done that yet. So, you have to get through, and you can see again the last real bear markets that we had here. You have to get through the 200-week moving average and then stay there and bring the 50 below it. That's what's a bear market, right? You have to get through the 50-day moving average and stay down below it, the 200-week moving average, and bring the 50 down too eventually. That's what so we haven't even got the price below the 50, much less the 8 or 17-week exponential moving averages, much less the 50, which is still way up there. So we're still actually in correction mode here until we break that 200-week moving average, which by the time we touch it will most likely be at or above those June lows. We have to break that and then stay below it, right, and not come right back above it like we did in COVID. Like we broke below COVID, and 3 weeks, 1, 2, 3 weeks later, we were easily back above it. So we can't have that. It's got to stay down there. It was too volatile to be. That was really mostly a pullback there. Just a really, really deep one because an anomalous situation there with COVID. So, so again, a real bear market like the VIX is kind of telling us that people aren't worried about a correction. See, when you can see there in the fourth quarter 2018, when you had a real correction there, when you filled in the gap between the 50 and 200-week moving averages, that's a legit correction. When you look at it here on this chart, 2018, we did get up to easily 115, 125% because people expected that to just be a correction. VIX got high, but the VIX 3M didn't get high, as high, right? And so that's why the ratio spiked. Well, the problem is the VIX is getting high, but so is the VIX 3M, which means, that people again don't think this is just a correction, that they're preparing, that they're planning, that they are. They are protecting against the worst case scenario, which is, again, like a real bear market developing there. All right, now let's take a look at what's driving the price action today. And obviously, it was pretty obvious, but let's take a look at how these different asset classes performed coming off of that inflation report. So here, let's just go 5-minute chart. So you can see the dollar took off. Like it was up 1.5% today, reversing a lot of its recent losses. It jumped up sharply. And of course, the strong dollar all year long has been pressuring equities, but the Qs just got hit the hardest, 5.5%. What's interesting, though, is usually commodities are pretty bullish. Now, commodities did easily outpace equities. So again, when we're talking about what do you buy when stocks and bonds both go down in an inflationary environment? Well, you buy hard assets, and that's commodities and gold are asset classes that are just outpacing paper, except for the dollar in this case, rising up to, which you wouldn't expect to do for an extended period of time here. But it's really putting pressure on the dollar. It continues to be really parabolic when you look at it on this chart. We're above the 8-day moving average, but when you look at the weekly chart, we're back above the weekly. There we go. We're easily above the 8. We never did get below the 8-week moving average. Never really has significantly gotten below it for most of this year. It's been a ramp up to the upside, and last week's decline. We've been a lot closer to the 8-week moving average than last week, and a lot of people thought last week was. That was kind of a dark cloud cover pattern or whatever you call that, kind of reversal type candlestick pattern, but that didn't last, right? And we are like that MACD between the 8 and 17-day moving averages. You have to go back to 2014 for as big of a rally as we're getting right now. And even in 2008, when financial crisis was hitting the fan, we were, had a bigger move then. This has been pretty gradual coming off of the May 2021 low point on the stochastics and the MACD. They've been in bullish territory pretty much this entire time, and just gradually get more and more parabolic as we get more and more up above like that 200-week moving average. When you look at it on this chart, it goes simple here. We are more than 13% above the 200-week moving average. That's about as far up as we got in early 2015. Remember, that sparked a pretty significant global slowdown in 15 and 16. And then, of course, by the time we hit 2018, we were right back there. We were worse. And by the time we got to COVID, the dollar was at a higher level than 2016, coming off the election, than 2015 when we spiked up as much as we did there, and crude oil dropped like a rock. The dollar's even higher than all of those levels. So it just continues to be very, very strong. Bonds have been very, very weak, right? They've been on their bear market. We are 23.5% below the 200-week moving average. When you look at the regular MACD, so let me go back to the regular MACD here, 8 and 17, and go exponential on that. You can see that we are diverging like a madman, right? So we're getting easily lower lows on TLT, but the MACD is we've already washed out here in May, and we're easily higher now. Yes, we are back below the moving average, and yes, we are still below the 17-day. So we're on a bearish run right now, but it would have to, we'd have to really get lower, and that's the lowest TLT has ever been, on the MACD has ever been. So TLT is in the process of bottoming out. Whether it gets to 100 or not is where, or 102, where we got down to at the end of 2013 when we were in the QE3 phase, remains to be seen, because TNX has still got a long ways. 2007, before we started that bear market, we were at 5%, and inflation levels, as we saw today, are high. And for us to get to positive real Fed funds rate, and for those of you who follow me on Twitter, I posted this thread today. So check out this thread. It's got about 12 tweets in it. It talks about inflation and why it's different now, including this chart here. You can see the correlation with bonds and bond yields and stocks is generally pretty positive. There's some times where it's been, sometimes it's briefly negative, but not very long, not by very much. There's been other times where it's been negative for quite a bit of time. But all these other times, even going back over here, I don't know why it's not showing up here, but going back over here, every time that the correlations got this negative below the 50% mark, and stayed down below 50% for that long, yields were dropping. But that's not the case right now. We're down below 50% and yields are rising. And typically when you're in an inflationary environment like we are, bonds and stocks move together. And that's what we're getting here, is bonds and stocks moving together to the downside with yields rising. So that's much different than we've seen for a long, long, long time. So whenever people talk about inflation and this narrative of commodities peaking and soft moderating and rates peaking, they are basing that off of this idea of how inflation has worked for the last 3 decades. But that's not the case right now. We are in a much different inflationary environment than we've been in for most of our professional careers or lives and our trading lives, where we've been active retail traders. This is not the same. It's not that this is unique, because we've been here before. Back in the 70s and the 80s, Powell told us at Jackson Hole what he feels like he needs to do to break inflation, and that is to get the real Fed funds rate above 0 again and keep it there. It barely got above there twice, and the Fed put the brakes on being restrictive. In fact, and went pretty accommodative almost immediately here in 2019. Just getting a little bit above 0 really. And so what Powell's saying now is we can't do that anymore. We have to do, not like what happened in the mid-70s with Arthur Burns, but we have to do what Volcker did in the late 70s, early 80s, and that is jump up the real Fed funds rate above zero, significantly above zero, and then keep it there. Like we did in the 90s, and like we did prior to the great financial crisis when they were trying to break that housing bubble. And so, this, where we're at now, if we didn't have all these other days or weeks before, that what we have right now, this would be the lowest real Fed funds rate that we've ever had, right? It's below these two levels. The Fed, when they got there in 1980, the Fed raised rates from 8% to 18% by the end of the year. Like, they raised rates. When they got the real negative Fed funds rate, they lifted it. And they lifted it hard and fast and got it above zero and kept it there. In 1970 here, they didn't. They got it, so it eventually kind of gravitated back to zero, but couldn't get above it, and we still had issues. And so we still have to get up to positive levels, which means that inflation has to drop like a rock, which I don't think we want based off of what you read here in this thread, or the Fed's really got to raise rates a lot faster than 75 basis points. And that's kind of why you're seeing the odds of a rate hike for 100 basis points for September increase up to 1 in 3 chance now. I mean, it was 0% yesterday. And now we have a 1 in 3 chance we'll get a 100 basis point hike because the Fed remains extremely behind the curve. And if they're going to follow the previous pattern, which is not any of these patterns, right? The 90s or the last few decades, this isn't the same pattern. They can't follow those patterns because this isn't the same environment. This is an environment very similar to what we saw back here. This is the pattern that they're going to be following. And there is hardly anybody on TV, except for maybe Art Cashin, that was involved in the markets professionally there. So that's why when people talk about what they think inflation will do, they're basing it off of their experience, which is this, not off of what the environment we're in, which the past precedent is back here. Let's take a look at how the sectors performed today. So give me 1 second. XLC just got hammered. But XLC was the one that wasn't doing good to begin with, as we talked about in yesterday's market outlook. But you can see it just continues to get hammered. But look at XOK, XLY, XLC. That is not what you want to see, right? We weren't seeing those as leaders, unfortunately, and now they are leaders on the downside. That is not what you want to see from a broad market perspective. And just like that, the Qs are underperforming IWM, and that's not bullish. Right? The MACD is dropping. The long-term PPO continues to drop. And we haven't even broke the 200-week moving average yet. Like, that is when this ratio breaks that's when we're going to be more in a bear market than we've ever been. I mean, again, you go back years here, that last 20 years, 20 years, and keep it on the weekly chart, you can see where 2008 where we dipped below the 200-week moving average on this ratio. In the last bear market before that, we were below it because the Qs got hammered and never recovered. They weren't the big leaders. Right? There wasn't such a market cap discrepancy on the Qs. But if I were to go back, and I don't think it lets me, because it doesn't have. Let's see how far back I can go. If I can get back to late 1990s. Let's go 1990 and see what we can do there and keep it weekly. Okay, so here's 2000. So we can't get a 200-week moving average, but you can see where it would be, and you can see where the 50 is. I mean, we had pretty wide disparities between the technology sector and the rest of the market. Very similar to what we're getting now, and things are rolling over in a big way now. I mean, we're still at 10% on this long-term PPO. It's just the gap between the 50 to 200. That's bigger than any other time since the great financial crisis. Like, we've been more bullish. We were kind of bullish there going into the beginning of 16, and then we dropped down. We're more bullish now than we were then at that peak, even coming off of the 25% peak there in coming off of the COVID low point. So, we didn't like that. We did not want to see this continue to get lower. And I've also shown you from a breadth standpoint the highs and the lows. This will be updated today. It's at 168 right now. Watch for this to get updated here later this evening to drop below. I fully expect it will be below that moving average when it gets updated with both the NYSE and the NASDAQ composite. And then the other one we look at from a breadth standpoint is the McClellan oscillator. And again, you can see we're back to negative. So we talked about getting back above 50, I mean, at least above like 35, and we couldn't do that. So, and we're still negative on the summation index. Let's look at the 12 grid on the sectors. And you can see that we have dark pink shading and a red line on industrials, discretionary, communication services. You're almost there on technology. You're at 20.92 and rising, but that's not going to last long. You have red lines on financials and healthcare and materials, and looks like utilities is going to double top. Remember, when the markets are bearish, everything drops, even your safety drops. It is maybe to lesser degrees, but everything drops, and that's pretty much what we saw today. All right, now let's talk about our trade idea of the day, and I want to take a look at UPS. UPS has been doing much better than FedEx has been doing, but today it finally kind of broke down. It looks like it was going to get back to dark green shading, a green line, after all these bull tags, and then we just failed. And this is the lowest close of all of these periods. The intermediate line was trying to get back in the bullish territory. It's still below its market sentiment line. It's breaking down. Market sentiment line is pretty high. So that means we got some room to fall. The near-term line got up above 80, but not by much, not for very long. It's already out of bullish territory. We're more than 3.5% below the 30-day moving average, which is more than any of these other periods that we were bullish. So it's a significant decline there. When you look at the long-term move, the weekly chart for UPS, we got the red arrow on the weekly moving average. We were bullish up until today, and now we have this transition candle, and more than likely going to get a close either this week or next below that body. More likely that's going to be the case, and a stock can actually close up above it, right? Just like with the broader market. When you look at where we close relative to these moving averages, you can see that we are back below pretty much all of them. So yesterday we had gotten above the 30. Today we broke the 30, the 17, the 8, the 17, which are in bearish levels, the 200 and the 50, all in one day, close above all those moving averages. The MACD closed back below its moving average, and it's not very negative. So we had a pretty decent histogram there, but we didn't get very negative like we did over here when we had that bearish move. So I think we have the potential for a new bearish leg lower on UPS. It's just starting. The negative jumped up above 30 for the first time in a while. The positive is not below 20 yet, but it's back below 25. When you look at the Ichimoku cloud, we are not below the cloud, but we are back below the green line after a couple days above it and failing to get above the blue line. The green's already below the blue line. And we don't have a bullish trend at all going anymore. When you look at like the stochastics indicators, and the S&P got above there yesterday and then failed. So obviously we've talked about that before. Well, UPS did not get above its moving average, and it's all the way back down to really low levels. So just like that, we're pretty bearish. Here's the whole moving average for UPS as well. Again, we've reversed. We're going to flip that parabolic star probably tomorrow, and we're already pretty much below the 20-day hull. So that's we're going to flip that around too, more than likely here pretty soon. In fact, if I change this PPO and look at the 20-day hull instead of the 200, you can see we are 1% below the 20-day hull already. So things are reversing to the downside for this, but considering that it never really was too bearish and try to get it going, there's more downside potential on this stock than others. So what I decided to do on this trade was come over to the chain and buy the at the money put and then sell one strike away. So relatively higher probability long put setup, but going with a full position size. So if you can see if I get rid of their trade. So this is a trade that went through. So we got in for about $1.70 or so for a full position size here because of the higher probability nature of the type of market we're in. going for about a 2-to-1 reward to risk ratio, knowing that, if we start to fill in this gap, then I don't have to wait for things to get to maximum loss. I can go ahead and, if we get back above this point of control and turn things around, it's going to be pretty obvious it's not going to continue lower. But until that happens, I can continue to ride this as long as that max gain stays inside of the shaded area, which is 1 standard deviation move between now and expiration. Then we got a good chance of that working in our favor. All right, before we get started, I invite you to subscribe to our YouTube channel with that icon right here. Hit that thumbs up icon to like our video, comment down there on anything that stood out to you from today's video. Join us at marketscholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created.